Good morning, good afternoon, good evening, wherever you are. This is Silverbusters coming at you with another video. And today's video is going to be another one about inflation because we just got headlines coming out. I guess this is for the second month in a row that we've gotten a very high inflation print, official inflation print of 5%. So if you don't know what inflation is, real fast, inflation, you can get into semantic battles with people, but basically there's two main schools of thought. The Austrian school says inflation is the increase of the money supply, which has already happened, and then what it's kind of morphed into over time is rise in cost of goods and services. So inflation, what the government measures is price increases. So when you see a 5%, month over month, year over year. I mean, that's not 5% in 1 month. It's like if the whole year goes like this, it would be 5%. When you see that kind of number come out from the government, it's significant because the government has a vested interest in underreporting the inflation rate, and there's a lot of reasons for it, but I'll go over some of them. One is that whoever is in power is more likely to stay in power if people believe the economy is strong, right? That's well documented, and they will do all sorts of things to try to adjust the numbers to make them look better. And since inflation comes off the top of GDP numbers, so GDP is gross national product. It's usually what people use to measure the economy. It's not a perfect measure, but it's one of the most commonly used ones. And so to get the real GDP number, you're trying to measure the increase in all the goods and services available when you're making a GDP number. So if a price went up on something, you're not really selling more goods and services, you're just increasing the price. That's the reason why inflation has to be taken off the top of GDP when you're making your statistics. Your real economy is based on the amount of goods and services available, not the price of stuff. Like if I had 10 coconuts and they're worth $1 a piece, and my economy size is 10 coconuts, right? $10. Well, if I just arbitrarily revalue them to $10 each and they're $100, I still have 10 coconuts. The size of my economy hasn't changed, right? So that is a brief kind of primer on inflation, but it goes to show why the government is keen on underreporting this number, because nobody likes inflation. Few people understand it, but the people who do understand it, and whatever level they understand it at, like when they go to the gas pump or the grocery store and they grumble because the price is going up, they don't want that blame going to the government, when oftentimes it's the government that deserves the blame for it because they've been increasing the money supply. And when you increase the money supply, sooner or later, that money is going to seep into the real economy. And when it seeps into the real economy, that means there's more dollars chasing the same or less amount of goods, because we've had the whole COVID thing and the supply line disruptions thing. I mean, we should be getting over that at this point, honestly. At least where I'm at, we've been completely open for a while, but I know in other places it's still quite serious, depending on how the local government has responded. But that's, the government doesn't want it. For one thing, they want to get reelected. They want people to think the economy is strong. They want good GDP numbers when they're in. But there's also this thing called cost of living adjustment. So if you've got somebody that's on something like Social Security, whether it's retirement or disability, which is a large percentage of the country at this point, we've got a lot of boomers collecting a lot of checks, and they are entitled to a COLA, a cost of living increase, for inflation to offset, their investment that they made. So if they're getting a check for $500 a month and they print 5% inflation for a year, in theory, they should be getting $525 next year, right? Because they need to maintain their standard of living, the amount of money they're getting to keep them at that basic level that Social Security has promised them for paying money in all over the years. but they don't really want to send out those increases because every time they make those increases, it shows how fragile Social Security is and how really that it needs benefit cuts and not benefit increases. But basically, it kind of reveals the long-term lie of the Social Security program that they could keep up this Ponzi scheme where you have more and more people retiring and fewer people entering the workforce. And those people in the workforce, because so much of the economy has been outsourced to other countries, don't pay taxes at the same rate that they did at 40 or 50 years ago, not because of the tax rates, just because the jobs aren't as good, they don't pay as well, and they didn't have as many kids as the prior generation, so there's just fewer of them to pay taxes. So anything that further weakens the Social Security program, which these inflation cost of living adjustments do, they are happy to do that because it's in their best interest to maintain that illusion as much as possible. Well, how do they maintain that illusion? Let me show you. This is shadowstats.com. The government used to have, back in the 1980s and past, a far more realistic measure of inflation that would record a fixed basket of goods and show you what your standard of living. Because if you get a fixed basket of goods, that includes ground beef, milk, bread, fruit, a house, a car, and measure that at a steady level, then you can tell. If you basically, the point is, if you don't do that, if you don't maintain a steady set of goods, how do you even know what you're measuring, right? You're not measuring the same thing over and over again, so you're massaging the data, right? So if 1 week I measure the value of a steak, and a month I measure the value of ground beef, and then in the next month I measure the value of dog food, right? Declining in quality each time. Is that really an inflation statistic? Yes, all three are meat, but they are not the same thing, right? So you're not measuring a sustained quality of life, getting any kind of consistent measurement when you're following that pattern. And that's what we see the government doing. That's one of the things that is built into their system since the 1980s. And you can see the divergence of these lines, where the further and further we get from the original measurement system, the more of the space that's filled in between what the real inflation rate is and what the made-up imaginary government inflation rate is. So substitution is what they call that. So like I said, with the steak, they'll say, oh, steak is expensive, so we're going to substitute chicken. Well, chicken is not the same thing as steak. You can't just substitute stuff whenever you feel like it. Another way they mess with it is with something called hedonic adjustments, right? So imagine this, right? Say for some reason a video game console is built into the inflation statistics, right? It's 1985 and we're buying a Nintendo, right? The original Nintendo Entertainment System, and I remember it being $100 at the time, and we got the set that had the controllers and the Mario Brothers Duck Hunt and the Zapper for $100, right? So 1991, 1992 rolls around, and you've got the Super Nintendo, right? Okay, so the Super Nintendo has better graphics. It has, more capabilities. It shows more colors, but it also costs twice as much, right? So the inflation statistic guy wants to figure out, well, how can I say that this product that is now $200 7 years later is actually a decrease in price instead of an increase in price? That's how they start out thinking right away. Now, as a kid, I was just as happy with the Nintendo as I would have been with the Super Nintendo. Obviously, after you have the Nintendo, you want the Super Nintendo. But as far as entertainment value, number of hours played, number of games available, arguably the original Nintendo was a better deal than the new one in terms of raw hours of entertainment value obtained, just because they had a broader base of games and they were cheaper to purchase and they were more mass produced than the Super Nintendo was. They just sold way more of those, right? And the Super Nintendo costs more. So, this is both basically in the entertainment slot. It's just, what are we producing as entertainment? It's the same thing. The product is entertainment, video games in this case. So we should reflect the fact that that video game console cost twice as much as it did in the past, right? That may be, a hard to follow example. So I'll try to think of another one. Like, let's say you have a Honda Accord in the 80s. I think they had Honda Accords. So think of a small, compact, not, subcompact, but not compact, but not subcompact, 4-door family car, commuter car, right? And it gets good gas mileage. It's relatively safe for its time. It's relatively reliable for its time. And then 10 years later, in 1990, you get a new version of the Honda Accord, but it now has anti-lock brakes and a headlight switch that automatically will turn off your headlights if you forget to turn them off, right? So it's got these two new features built into it. And maybe it gets slightly better gas mileage, right? Okay, so it's got a few new features. So, but it costs a lot more. The Honda Accord in 1985 compared to 1995, or 1980 compared to 1990, you're talking about a few $1,000s more for this vehicle. So if I put that on my steady, stable inflation list, right, my basket of goods, it's going to show you that if I just put it in raw, it's like, oh my God, this car is getting more and more expensive. Like, go look up old ads for vehicles back in the day. It'll be like, yeah, get this 4x4 in truck for like $7,000 brand new. It's like, what? Like, you go look for a truck now, it's like $50,000, right? So it's just ridiculous. The inflation rate should reflect this huge increase in price of, commuter vehicles, right? Even a basic commuter car, something that has 4 wheels, good gas mileage, and air conditioning in it. I don't even think you can get into something like that, unless you're talking about a tiny little smart car or something silly like that. Holds 4 people reasonably comfortably. You're talking, Jesus. I bought a used car 3 years ago, and it was used, so it's not even really a direct comparison, but it was 12 by the time I paid for taxes. It had 60,000 miles on it, and that was a Hyundai. It was a Honda. But the point is, the government will say, aha, well, this new car has anti-lock brakes, and it has an automatic off switch for your headlights, and it has a better gas mileage. So all of that price increase is actually not a price increase, because you're getting all of these benefits from the new features, and actually we need to lower the rating in our inflation index, because these features are so good that they actually reflect a price discount, right? So yeah, that's the government term for hedonic adjustment. So they'll say, oh, well, this is a better product, therefore it's a better value, and therefore it needs to be reduced in inflation, even though the price is obviously higher. And that's always an unobjective benefit, right? Because who is to say, nobody can really accurately measure the exact value of those tiny little feature changes. And realistically, if you're just someone who needed to get to work, you would have gotten to work just fine in either of those vehicles, right? If you're just trying to live a regular life and be a commuter worker, whether the car had anti-lock brakes and off switch and 3 miles per gallon better gas mileage, it wasn't going to radically change your world for you, especially when you're considering that there's a big change in price between those two products, right? So that's the other big way the government does it, is substitution. Another thing that is just kind of sneaky inflation, not necessarily government inflation, is what we call shrinkflation. That's when you go to the store and you get the bag of barbecue chips, and you grab the bag and it's this big puffy bag full of air, right? And you shake, and like the bottom third down at the bottom has actually got the chips in it. I was around as a kid, and they actually like packaged chips the way you should to actually be efficient. They filled the bag with chips. Now they're like, well, we got to keep the bag the same size. We don't want to raise the price. Hey, what if we just put less chips in every bag to screw over people? And they do this on everything. And if, we're talking like if you're getting a chicken, they are injecting it with salt water or additives first, and then charging you extra per the pound for salt water, essentially. If you're getting products, they'll substitute lower quality ingredients, but keep selling it for the same price, especially things like spices and pepper. If you see how tiny the little canisters are getting for spices, but just anything like that, anything where they can cut corners and try to not reveal to you that the underlying product has changed, but the price has either stayed the same or gone up. That's shrinkflation. So we're kind of getting these on all the fronts now. And the real cause of all of this is the government money printing. Anytime the government isn't even bringing in half the amount of money it needs to cover its debts in taxes, right? So if they want to spend $6 trillion this year, they're only bringing in 3 in taxes. And it's not like we can just snap a finger and close that gap. If you want to effectively double the tax rate, you will cause some real stress and real people. You will not be able to target just the rich for another $3 trillion per year. You'll have to do it broad base and hit everybody for it. And believe me, they won't be happy to see that you've doubled their tax bill, and they won't be able to maintain their same lifestyle. A lot of people may actually be out on the streets if you double their taxes, right? So it's just a nightmare with this inflation. And the reason why we're getting the inflation is this government money printing. And it would be one thing if the government was deficit spending and they could actually get regular people to invest in their bonds, in their treasury bonds. You can say, oh yeah, I'm going to, I need to save for the future. So I need to buy some 10-year treasuries. Well, let's Google what a 10-year treasury rate is right now. 10-year U.S. treasury. So if we click on this from CNBC, if I invest in some 10-year U.S. treasuries every year, I will earn 1.454%. Okay. Well, wait a minute. Weren't we over here? And even the government says we're running at a 5% inflation rate. So let's do the math. I'm losing 5% of my purchasing power due to rising prices, and the government wants me to invest my money with them for basically 1.5%. So that means 3.5% per year I'm losing on my money, right? So naturally, no one thinks this is a good deal. The only people who would invest in this might be people investing in foreign currencies that are so horrible that the US dollar still looks better, right? So if you're in some third world country, maybe you switch into dollars because the inflation rate in your country is 25% and the inflation rate in America is only 5%. So it still makes sense for you to invest in America. But really, You should be investing in something else, something that gives you a real return above the rate of inflation, because otherwise you're not really making any money. Because at the end of that 10 years, when you get the 1.5% a year from the government that you've earned, and you go to the store to buy bread or milk or a new Honda so you can commute to work or whatever it is, you've actually lost money, even though you sacrificed for 10 years and didn't spend money you had. So this is a big problem. No real people, no real entities, no one who isn't involved politically is purchasing a 10-year treasury. The only people that are doing it are central banks, really, and through their cronies, because central banks have a lot of member banks through, the big banks. So you're talking about Bank of America, Citibank, Chase, your big mega banks, right? So they say, "Oh, look, these banks are buying these loans." No, they're not. No, they're not. They're in cahoots with the Federal Reserve and the Treasury, and they're just recycling this debt in order to monetize it. They get money from the Fed, and then they use the money to buy the treasuries. That's not a real investment. That's just them using one hand to wash the other. It's not a legitimate business practice, because no one wants this, right? No one really wants this, to lose 3.5 guaranteed loss of 3.5% a year, right? It's utterly stupid. No one wants this, but that's what they offer people. And guess what? If you are a dummy that has a 401k, I bet you if you have a 401k, dollars to donuts, you probably have some U.S. Treasury bills, notes, whatever duration. You probably have this exact kind of setup somewhere in your portfolio. Just call them up. Get that 1-800 number from the statement and say, "Hey, do I have any guaranteed negative yield Treasury bonds after inflation in my 401k? Because losing 3.5% a year every year guaranteed," and remember, folks, that's to the government numbers. Remember we talked a while ago where the real numbers, when we get out here and do them the way they used to do it with a steady living standard, double that, basically double it up to 10 or 12 if they're at 5 right now, right? Take that number right there. So call them up and say, it's like, and use the regular one, because when you're talking to your broker, because he won't like to realize this. He'll tell you, "Oh, this is a conspiracy theory," and "Oh, this is the real." No, but when we go to the grocery store, it's this number, right? When we go to the gas station in the grocery store, it's the real number. When we have to live our lives and pay housing costs and healthcare notes, don't even get me started on housing. They have this weird thing called owner's real rent or something like that. They don't go out and measure the price of a house, because if they measured the price of a house right now, it would be up $30,000 to $50,000 just for the cost of the lumber, right? If you're trying to get your foot in the door in the housing market right now, forget about it, because it's gone up more in a year than most people make in a year. Okay. So you're never going to get that house if you stay within this system. So yeah, just call them up and say, "Hey, how much U.S. Treasury exposure do I have in my 401k? Because I heard that with the inflation rate, I'm getting a guaranteed loss every year. Is that right? Am I getting a guaranteed loss every year after inflation?" And let's just see how they respond. Like I said, don't use the high number, use the regular number, because it's the same either way, whether you're losing 3.5% or 7.5%, or more than that. And here's the thing, people, it can get worse. This is not as bad as it can get. It can get a lot worse, because the money is already out there. If we do Federal Reserve balance sheet chart. So we'll see if we can get a chart of their balance sheet. So there it is, folks. You can see this is after the 2008, and if you go back past this, relatively flat before 2008. And this is like almost all the quantitative easing and programs and such that we did in response to the 2008 housing crisis. And then you can see they actually tried to taper back a little bit here, but they couldn't hold the pattern. And then when we got to, and honestly, I don't think this really has much to do with COVID. This even in this time period here, because a lot of this ramp up before this started before COVID even got started in a big way. I've got a video on the repo market, the reverse repo and repo market, and they were kicking this off in September, October, before COVID. And then COVID gave them enough cover. It's like, well, we got to print. And here we are today, up just a tremendous amount from any of these baselines, basically double back there. And it's just insane. That's the dry powder. And they're saying, well, silver busters, that money is not reaching the real economy. That money is just bank reserves, and it doesn't reach the real economy. Come on. You know how banks work. You know, somebody is getting paid money that they shouldn't be getting paid. They're making a big salary based on they're getting paid interest on these reserves. It's all bleeding. It's bleeding, and it's dry powder. So if they decide to make a loan, it's all the dry powder is there. They've got the reserves anytime they want to. So if the scramble starts to secure commodities at any cost, there's a tremendous amount of dry powder in the system, because it is true that banks haven't been making as many loans as they have been making in the past, but the dry powder is there. So at any time, we're already seeing it bleed into the system, and we're getting these official 5% prints, when really, if we did a more honest adjustment, is going to be higher than that. Right, especially if we do the kind of inflation that's experienced by a working class or a middle class person. We're not talking about, people dealing in yachts and mansions and that kind of stuff, right? So it's all there. I know I'm kind of rambling a bit right now, but yeah, just call up whoever manages your 401k and ask them, how much money am I losing every year on my treasury bonds because of inflation? And it can get worse, people. 5%, official 5%, is not where it has to stop. It can get higher, and it will get higher. And that's why I think things are looking good for silver. And here we are back at the findbullionprices.com. No affiliation. Just think it's a cool tool for checking silver prices. Saves me some time. And once again, we're looking at the generic 1 ounce silver rounds that I kind of consider the benchmark for the silver price. Only a 14% premium, similar to what we were looking at last year. A few other dealerships on here that I didn't see. I guess I was looking at Buffalo's last week, and this is more of a kind of a broad 1 ounce generic round measurement. And so we've got some other dealers that are actually in a pretty similar range. And I think you'll note down here, silver has managed to hold 28 handle again. It's been going through it's in a real tight range. So holding 28 is a big factor for us. I'm not your technician, so whether it's going to break up or break down, I can't give you the kind of detailed chart analysis somebody might be able to give you. But the fundamentals, when you're getting a 5% inflation print and silver is holding steady, that's kind of, you may even think, well, hey, maybe this is a buying opportunity, because I know I'm saving at least 5% by getting into a hard asset because of the government. And let's be realistic, it's probably more than that because of the way the government lies about the inflation numbers. So may be a good opportunity, because this is everywhere. This is not Alex Jones screaming about UFOs and gay frogs. This is CNBC. This is Forbes. This is the mainstream media. This is the Federal Reserve website. The only thing on here that is even slightly alternative news is the trying to adjust back to old government statistics in the 80s versus new massage data that tries to pretend that because you have an iPhone, your life is so much better. It's like, no, your life is probably worse if you have to stay in your tiny apartment and be on Facebook all day because you can't afford to go out and do anything, right? So that's my rant on inflation for this week. I hope you got some useful out of it. Hopefully you might understand things a little bit better about what's going on in the economy right now with inflation. And folks, I don't think it's going to stop. So if you haven't done anything to protect yourself, food, water, non-perishable food, so stuff like rice and canned food, guns and ammunition to protect what you have, gold and silver to protect your wealth and buying power, and try to get out of debt, because these banks and governments are famous for changing the rules anytime it benefits them. So you might be thinking, oh, I've got a lot of debt and I can pay it off with inflated dollars. Don't bet on that. Because you've seen it with GameStop, we've seen it with the Hunt brothers. Anytime it's in the government's favor for somebody to cheat and break the rules, as it would be in this case with you paying off your mortgage with cheap dollars, watch for the banks and the government to change the rules on you. Say it's like, oh, you owe $100,000 in the old dollars. Well, guess what? You owe us $100,000 in the new dollars. And it's like 3 times as hard to earn those new dollars because of the devaluation that's been built into the system. Watch for them to do that, because they are not above changing the rules anytime it suits them. We've seen it in GameStop. We've seen it in silver. We've seen it in other markets where they will change the rules. They'll change the margin requirements. They'll declare force majeure. They'll go into the legalese in the contract, and they will stab you in the back. And if you have a bunch of debt, you are exposed. And so I would not recommend that course of action in counting on your debt being washed away in a hyperinflation. Anyway, folks, that's all I've got for you this week. This is Silver Busters signing off. Hope you're having a great weekend wherever you are. I will see you in the next one.